Hi, I'm Christina Trauthwein. I'm the editor-in-chief of Hotel Business, and I am here right now with Peter Berk, and he's the president of PMZ Realty Capital. Welcome.
Well, thank you very much for having me, Christina.
Okay, so let's talk about your company a little bit and about your advisory services.
PMZ is a New York-based real estate intermediary. We focus solely on hotels. We started in business in 2002. We do somewhere between $600 to $800 million worth of hotel transactions a year. It's all success-based deals. We work on fixed rate loans, floating rate loans. Although we're headquartered in New York, we do deals all across the country. And kind of our role as an intermediary is to find the right checkbook for the right deal. So clients come to us, describe what they need, whether it's a cash out refi, a construction loan, a flag change. They're buying a hotel, it has operating history, it doesn't have operating history. Now there's lots of different stories. We hear the story and then we go out to the market and speak to our capital sources and find them the appropriate capital that matches their business plan for the deal.
So let's talk about the current state of the financing market and specifically how rates are.
The hotel financing market is heavily dependent on what's going on in the national market. The national market is, the stock market, the bond market. When those are suffering, the real estate market, and specifically as it relates to hotel suffers. Right now, the national market is doing great. So for a 50% leveraged asset, the rate's probably 4.5%. For a 70%, or what we call a fully leveraged asset, the interest rate's anywhere between 4.75% and 5% for fixed rate loans. For floating rate loans, the interest rates are in the low fives. And floating rate loans tend to be more story-based because those are shorter term loans. So someone is either buying something, fixing a problem, doing a PIP or something like that. So that interest rate tends to be slightly higher, but those are interest-only loans. There's no amortization.
Okay.
So it all depends upon each particular asset, but anywhere to the high fours to the low fives is a good benchmark.
Okay, good to know. What is your outlook for hospitality financing in 2019 or the remainder of 2019? And then certainly into 2020 and beyond.
My outlook is very strong. Again, multiple offers on any transaction. There's not a great amount, although there is new supply coming. There are very few markets where we've heard that there's a lot of oversupply, so that's good. That's what led to some of the problems last time. And a lot of the local banks who provide construction financing have been a lot more cautious on what they lend for new construction. So that has kept new supply down. And RevPAR, although not growing as quickly as it was in 2017 and 18, continues to grow in the very low single digits. So that's good for our business. And good when we present a deal to a lender that we can say, hey, this isn't going to grow at 5% next year, but we can show steady year over year increases, even if it's only 2% or so.
Brand segmentation is a hot topic, okay? And it seems like there are new brands coming online, not every day, but often. So how do you evaluate the opportunities in terms of financing when there are so many brands out there and when some of them don't have obviously a proven track record yet for the brand's new offering?
Well, I have a great example for you, Christina. We did the first CMBS loan for a True by Hilton. It was a True in McDonough, Georgia. And that was a deal. Obviously, True is a new Hilton brand. Because it was under the Hilton flag, even though one had never been securitized before, the lenders were able to get comfortable with it because it fell under the domain of a large hotel company. And the same thing with any of these new flags, whether it's Hilton, Marriott, Hyatt, IHG, Choice. As long as they're under one of the larger hotel companies, they will find a home, and there's not a great amount of explanation that needs to be done on our part because they know that brand will have the support of the parent company. Where a potential problem comes into play is these smaller, less known brands where they don't have that support, and those are harder to finance. And you're right, people would want a track record of that. Any of the large hotel companies will be fine. It's not a heavy lift to get them done.
Okay, great. Thank you so much for your time.
Thank you very much for having me.